Good afternoon. Today's lecture and the next week lecture will be on Islamic banking, advances and facilities provided by Islamic banks. This particular module is a optional area in advanced diploma in credit management, where most of the times for the exam you will have a choice between doing this question and some other questions. So what we intend to do today and next week is to look at some of the key advanced facilities or loans, equivalent of loans in conventional banking that is offered by Islamic banks, Islamic banking windows, and how they are different, how they are structured and how they are different from conventional banking. That's what we are going to focus on. So to start with, we will try to understand what we mean by Islamic banking. And then we will go into different types of product used to give facilities, give loans in Islamic banking. And then we will conclude. So during the sessions, we will go on a step-by-step manner. And we will also try to practice some questions during the process. And those practice questions are worth keeping in mind as we go on towards examination. So with that, we will move into the contents of the slides. So first of all, we will start by defining Islamic banks or Islamic banking as financial intermediaries, a financial intermediation process within the principles of Sharia. Financial intermediation process within the principles of Sharia. So when we say Islamic banks are financial intermediaries that operate within the principles of Sharia, what we mean by operation is that accepting deposits, giving facilities or advances, providing banking services, and then managing banks' own asset and liability situation. So that's the general role of any financial intermediary. As banking students, you will be familiar with that concept. So any financial intermediary borrows funds from excess units, that is, anybody who has excess funds, banks will accept funds from them as deposits. Those are called liability products or deposit products. Any other deficit units, people who need funding, will borrow money from the bank, so bank will lend money to them. Those are advanced products or asset products, or in simple conventional banking, we call them loans and advances. Then non-fund based services are offered by the bank. Those are called banking services, right? Often it is off balance sheet. Sometimes it's just pure services. Then on top of it, so these are fee-based products. Banking services are called fee-based products, and then banks manage their own deficits and liquidity, own assets and liabilities. Mostly it's done by treasury, so those areas are called treasury products. So excess funds, when we borrow from excess funds, we use what are called deposit products or liability products. When we give funds to people who need, we use asset products. When you offer banking services, we give fee-based products. We offer fee-based products. And then we have treasury products to manage our own assets and liability in addition to customers. So that's in general the overall categorization of products and that's same for Islamic banking too. That approach is same for Islamic banking too. But that is only one part of the definition. So when we define Islamic banks as financial intermediaries within the principles of Sharia, we first define financial intermediaries as having broadly 4 types of functions, especially looking at banking side. There are other types of financial intermediaries. We are not concerning ourselves with that at the moment. So these financial intermediaries operate within the principles of Sharia. So what are these principles is the next question that comes up. And to answer that, we need to understand the underlying thinking in Islamic banking when it comes to financing. Right, before I go there, I have to clarify one particular misconception or 2 misconceptions related to Islamic banking. Sometimes because there is this concept that Islamic bank does not charge interest, there is this concept Islamic banking is cost-free. Islamic banking is cost-free because there won't be any interest, so it's just free money. That's not the case, because if Islamic banks are financial intermediaries, the intermediation process can't be cost-free, because any intermediation process will involve accepting money from the excess funds, and then you have to pay them a return. Similarly, if you lend to those who need funds, you are going to charge a return. So to say Islamic banking is cost-free is not completely right. It is not correct. It doesn't charge interest, so in that sense, you can say Islamic banking is interest-free. But you cannot say Islamic banking is cost-free. Right? Any clarification as we go on? If you all have any clarification, you can unmute yourself and talk, so that I can respond to any clarifications you have. So that's the first misconception related to Islamic banking that could come up in discussions. It's cost-free, and the reason why we are saying is not cost-free, we will see in detail when we discuss the products, is that simply because there is no interest charge, it doesn't mean it's cost-free, because by nature we are defining Islamic banks as financial intermediaries. Number 2, because Islamic finance, because the prefix of Islamic finance, sometimes it's also thought this may be like a charity. You take money and give it to people. So again, that misconception needs to be cleared. If you are a financial intermediary, you can't operate like a charity, because charity takes funds from donors, like the excess units in our definition, and gives to people who needy. So it gives to kind of deficit unit in our definition. But only thing is, there is no channeling back of funds in charities. The money given doesn't come back to the charity, and those are not returned to the donors. So donation, charity is one-way street, whereas financial intermediation is a two-way street, meaning the funds are channeled by the intermediary Islamic banks to those who need funds, and then funds and the returns are converted, channeled back to the original depositors. So again, if somebody says Islamic banks operate like a charity, again, it's not correct based on our initial definition of Islamic banks. Islamic banks are financial intermediaries that operate within the principles of Sharia. So once we define that, there could be now further questions in your mind. Okay, why is that if banking, generally we say banking is borrowing on interest, perhaps at lower rate, and lending on interest at a slightly higher rate, and making money in between. And if you say there is no interest involved in Islamic banking, how is that Islamic banks operate? To answer that question, we need to understand the underlying philosophy in Islamic banking. And the underlying philosophy is that in any economy, you get four broad sectors of economy, 4 or 5 broad sectors of economy. One is called a real sector, where there is production, trade, and all that. Production, consumption, all that. Number 2, there is external sector, where there is interaction with rest of the world, interaction with other countries, imports, exports, and things like that fall into external sector. Number 3 is fiscal sector, which is government's activities in terms of income, expenses, and things like that. And then we have financial and monetary sector. For the moment, I will put both together, where there is borrowing and lending happening there. So broadly, in any economy, you can identify these 4 broad sectors. And if we identify any financial entity, at any level, this may be true to some extent. There are 4 aspects of activities. And what Islamic finance start by saying is any financial sector activity has to link to the real sector activity. Financial sector activity, the lending and borrowing of funds, channeling of funds, had to be linked to the real sector activities. And that link need to be established by transactions like sale transactions like partnership transactions, transactions like investment transactions. And that link has to be established using these transactions between the financial sector and the real sector. And financial sector on its own cannot grow, cannot be established only by borrowing and lending and doing transactions based on loan transaction. All funding requirements should be linked to the real sector or external sector or something like that. So real economic activity, if we simplify it a little further, real economic activity has to be the basis for financial transaction. That's the principle from which, that's the philosophy from which Islamic finance is built. So another way to put is, only if you look at financial sector, you can do borrowing and lending without direct link to underlying real sector activity. Whereas that is possible only because you use loan transactions. But if you say there can't be any loan transaction, all these transactions had to be linked to the real sector activity, then always, for whatever financial transaction, there should be some underlying real sector activities. So even the financial intermediation process, creating the arrangement of financing, can be facilitated by linking financial activities to real sector activities, using sale, using partnership, using lease, and similar transactions. And we can establish this. And the rationale for that is that if financial sector operates without direct link to the real sector or real activities, real economic activities, there is a risk that this financial sector or financial aspects, financial activities go beyond a certain limit, where it puts the people involved into some kind of debt trap. And that, in the original days of Islam, somebody who borrows beyond his capacity as individual is taken as a slave by the master. So that principle is totally not acceptable from the Islamic finance side. As such, any borrowing is linked to the real sector activities. And loan, if it exists, has to be what is called a gracious contract. What we mean by is gracious contract is the amount you pay, amount you give as loan has to be paid only based on the capital amount. There could be nothing else required. You can't pay anything more. So in modern terms, it's like a current account. If you are doing a loan transaction, it's like a current account. You deposit 10 million rupees in current account. As long as your account is not dormant, after 10 years, you come back and ask the bank will only give you 10 million rupees, not a cent more, not a cent less. The reason is the underlying nature of transaction is that there is no cost paid on loan contract. And that's the similar thinking in when it comes to loan contract. Of course, current account is used for transaction purposes and all that. We will come to that later. But the point is, loan contract from Islamic finance perspective has to be only a gracious contract, meaning it has to be paid only for its par value. But if there is some returns to be paid, it should always be linked to some real sector activities. We will understand this more as we go into individual products. So what we are going to discuss today and perhaps in the next session is these individual products, individual transactions, such as sale transaction, such as partnership transaction, which can create the same effect as giving loan and charging an interest. How that can be done is what we are going to cover this week and the next week. So before I start with, I'll give you a brief example of how you can think of this. Let's say I work in a company for a salary of 30,000 rupees. And the company pays my salary on the last day of the month. That is on the 30th of the month. Now, on the day one I work, company owes me 1,000 rupees because 30,000 rupees salary, 30 days available. Each day I will get a pay of 1,000 rupees. On day one, company doesn't pay me. On day two, I come and work, again, company doesn't pay me. On day three, company doesn't pay me too. So from day 1 to day 29, although I have worked, company doesn't pay me a salary. That salary is paid on the 30th day. So technically speaking, I'm funding the company for 29 days, and on 30th day, I'm receiving my salary. So providing funding need not necessarily mean you give a loan and then charge, you give a loan to somebody. Funding arrangements can be made by various structures, including the employment contract. Similarly, a sales structure, similarly, a partnership structure. All that can be structured to create this kind of financing arrangement. And we will look at them in detail, how it could be arranged as we move on. So the philosophy underlying that is, if this financial sector is not connected to real sector activities, there could be kind of too much financing, which is not in the good interest of everybody around. It's not in the interest of stakeholders around. So that's what underlying philosophy of Islamic finance is. Link the financial side, financial aspect of transaction to real sector transactions. If that link is severed, if that link is broken, it could lead to difficult consequences, which are not easy to address. So by connecting this, using different types of contracts, which are practiced all around the world, which are known to all traders, these contracts, Islamic finance proposes an alternative set of financing arrangements, which essentially ensures there is not too much financing. There is not too much financing. That word too much financing is actually, if you Google too much financing, there is IMF paper on that, which says, which kind of assesses link between the financing and GDP, I think, at a country level, and says beyond a certain level, financing can be a bad influence too. So of course, the empirical evidence are still coming, so that I'm not going to go detail into it, but this is the philosophy. This is something similar to the philosophy that is inbuilt in the Islamic banking setup. So once we have identified the underlying rationale for Islamic banking, now we will look at and say, although we can say banks' general business is borrowing on interest at a lower rate and lending on interest at a higher rate, there is another way to look at that, is to say banks sell liabilities with one set of characteristics and use that proceeds to buy assets with another set of characteristics. As long as these two create acceptable spread for banks, there could be banking even without borrowing on interest and lending on interest thinking, And this particular definition, general terms, banks make profit by selling liabilities with one set of characteristics and use the proceeds to buy another set assets with another set of characteristics. That is from Mishkin and Eakins, which is standard text. It's not an Islamic banking text. It's from Economics of Financial Markets, I think. So it's a standard text which define banks in general, core banking definition. So I think within that definition, we can do Islamic banking without actually borrowing and lending on interest. However, creating financial intermediary arrangements which are similar to conventional banking, conventional financial intermediation process. So how we will look at it, especially from the lending side of the products, right? Lending side we will look at during today's session and the next session. We won't look at either the deposit products or the fee-based products or, for instance, treasury products. We are not going to focus on them. We'll be mainly looking at the lending side. As a part of the advanced credit management program, there are, I think, around roughly 16 financial institutions in the country offering Islamic banking solutions. So if you are in one of those financial institutions in the credit division, or if you are in business, chances are invariably you may come across a file with some Islamic banking requirements. And although this program will not make you an expert in Islamic banking, it will give you a broader understanding of how Islamic banking facilities work, so that you will have a broader idea and you will make better sense of the proposal at hand. That's the underlying thinking on how we have incorporated these specialized areas in lending into the syllabus. So having explained what is meant by Islamic bank, so we defined Islamic banking as financial intermediate Islamic banks as financial intermediaries that operate within the principles of Sharia. Now we need to understand what are those Sharia principles. But I will only conclude by saying here in the first slide that those applications of those Sharia principles are decided by what are called Sharia councils. So all Islamic windows will have few advisors who advise them. They are Sharia scholars who will advise the Islamic financial institution how to apply these principles. So we will see what these principles are, but the application of these principles are advised by the Sharia scholars. So in that kind of concludes our definition and introduction to what is meant by Islamic banking to start with. Any questions so far? So what we covered so far is the definition of Islamic banking. So you should be able to write what is Islamic banking, the underlying philosophy of linking the real activity, real sector activity, or real activity of anyone to the financial side, because all the funding, all the financial arrangements that we will look at will always be linked to the real sector activities. So that link is what Islamic banking tries to establish on the rationale that if that link is not there, financing could create ill effects. Financing could create ill effects. Financing could create adverse effects, which can be detrimental to the parties involved in the longer run. So it doesn't mean finance will always create ill effects, but the philosophy in Islamic banking is it could create ill effects which may be detrimental, especially to the borrowing side, especially to the side which is taking the money. It can drive them towards difficulties. So that's what we need to remember. And I also clarified a couple of misconceptions about Islamic banking. Islamic banks can be seen as a charity, which is not the case. Islamic bank can be seen as cost-free banking, again, which is not the case. We will see that in more detail as we go on. The other is that we can also say there is also another misconception. Maybe before I start with the second slide, I will clarify that also. Sometimes it is assumed Islamic banking is only for Muslims. To some extent, it is based on the observation. Most of the customers of Islamic banking windows happen to be Muslims, but that is not complete truth in the sense. In the following sense. Number one, even from the customer side, there is non-Muslims who are using Islamic banking facilities, Islamic banking services. Maybe small minority, maybe 10%, maybe 20%, but there is still non-Muslims, people who don't belong to the Islamic faith, also use Islamic banking transactions. That's number one. Number two, that statement also look at only the demand side. But if you look at the supply side, Islamic banking is not offered only by entities owned by Muslims. It is offered by major international banks all over the world. For instance, the big boys in banking, the HSBCs, the cities, the Standard Charters, offer Islamic banking in many territories. So similarly, individual countries, secular institutions offer Islamic banking. As such, on the supply side, although on the demand side, large majority is Muslims, even on the demand side, there is an element of non-Muslims who use Islamic banking. And on the supply side, I would think large majority of the offering is by secular institutions, not only by institutions offered by owned by Muslims. So as such, it's not very, you can't say Islamic banking is only exclusively owned and operated by Muslims. That's not completely correct. Of course, a lot of customers happen to be Muslims, but we need to look at the overall picture to understand that statement. Right. Having introduced different types, definition of Islamic banking, the underlying philosophy, and then having clarified a few misconceptions with Islamic banking, now we move on to understand the Islamic banking framework a little further. Right. So when it comes to exams, it makes sense to note down some of these points, because when we come to the exams, these could be some small questions that could come up as we move forward. Right. So the framework to understand Islamic banking is to understand from the three disciplines that interact when we talk about Islamic banking. And those three disciplines are finance, which is represented by the stakeholders, customers and bankers. Laws and regulation, again represented by lawyers and regulators, and Sharia scholars represent the Sharia principles. So we need to kind of integrate these three disciplines and operate in this particular diagram, operate in quadrant D, where we achieve congruence with the principles of Sharia, law of the land, and the requirements of the customer. That's the only sustainable area where the bank where the financial institution, Islamic financial institution, will benefit in the long run in a sustainable manner. If Islamic financial institutions operate in quadrant A, where the requirements of Sharia are fulfilled, where the customer requirements are fulfilled, but they don't comply with the laws and regulations of the country, such a proposition is not sustainable in the long term. That kind of efforts will fail in short term. It cannot continue in the long run. Similarly, if Islamic banks operate in B, where they ensure Sharia compliance, where they ensure regulatory and legal compliance, but don't offer the customers, don't meet the customers' requirement sustainably, then again the sustainability becomes questioned. It may not be a long run operation. It will live very short life, because if you don't meet customer requirements, however good your Sharia compliance is, however good your legal compliance is, you are not going to survive for too long. Similarly, if Islamic financial institutions operate in quadrant C, where legal aspects are looked after, customer requirements are looked after, but the institution cut corners in Sharia, that is also not sustainable, simply because the reputational risk will destroy the company's right to go into this market space, and it will not be sustainable in the long run. So we have to ensure customer requirements are met. We have to ensure law of the land is upheld. At the same time, we have to ensure the principles of Sharia are not violated. And if we can design Islamic bank's operation in such a way that all these three requirements are met, then it will be a sustainable operation in the long run. Where there is deviation in any of these areas to quadrant A, B, or C, that will create issues in the long run. So if we are to think of issues in Islamic banking, the challenges in Islamic banking, or more than challenges, the issues in Islamic banking, the issues will come in quadrant A, B, or C. Any Islamic banks, any Islamic banking window, any subsidiary of Islamic conventional bank which does Islamic banking. These are the three areas that A, B, and C are the three areas that we should avoid operating in and try our best to operate in quadrant D. Of course, it is easier said than done, but that is the ideal way to operate to ensure sustainable operation. So if we are to identify three key challenges faced by initially as Islamic banking operation which is starting, we should say ensure customer requirements are met. Using number two, ensure principles of Sharia are met, and ensure all the legal and regulatory requirements are complied with, so that the operation is sustainable in the long run. Of course, and quadrant D also there could be issues like operational issues, the IT related issues or HR related issues, but that is the sweet spot in which all Islamic banks should operate in. In case they don't, they are operating on a model which is not sustainable in the long run. So that's a broader framework to understand Islamic banking and Islamic finance in general, and we can relate this to individual products too. So that would be a broader framework. So every product that we talk about, you need to think in terms of these broad framework to understand how we move on. So what I said is you need to ensure Sharia principles are met. What are those Sharia principles? We will discuss. Laws of the country, law of the land is upheld. The documentation, the implementation is according to the law of the land, and then customer requirements are met too. Any questions on that? Any questions so far on our discussion? Okay, we move on to the key principles. So when we initially defined Islamic banking, we defined Islamic banking as financial intermediation within the principles of Sharia. Now, what are these principles is what we are going to clarify now. Although it can be easy to misconceive, when we say Islamic banking, you might think Islamic banking means wearing a cap or something like that. Nothing is further, it's very further from the truth. Islamic banking, when we say Islamic banking, we are referring to ensuring certain key broad principles. As long as those principles are adhered, Islamic banking can be done by anybody. So we will go into details of these principles now, with the focus on what these principles mean for banking, what these principles mean and the implications for banking. So those are the two areas that we will discuss under each of these principles. It makes sense to pay attention to those principles. And the first principle is concept of permissible and non-permissible. So, like any other religion, Islam is also a religion based on certain values. It has certain value systems. And in that value system, certain activities are permissible and certain activities are not permissible. For instance, when it comes to the business transaction, trade transaction, what we are discussing, what is permissible is defined as everything that is other than non-permissible activities. When it comes to business transactions, when it comes to trade transaction, which we are going to study under Islamic finance, what is permissible, right, is defined as anything other than non-permissible. Everything other than the non-permissible activities. So what are these non-permissible activities? These activities are these are like businesses which are engaged in unacceptable things, such as gambling, such as certain types of adult entertainment, certain types of alcohol, tobacco, weapons. This kind of industries are not acceptable in Sharia. Other than that, every other business, every other activity, such as agriculture, such as manufacturing, large majority of services are acceptable from Sharia side. So the concept of permissible and non-permissible is like a value system. What is a value system? For instance, we have a value system in Sri Lanka. We drive on the left. The reason why we drive on the left is, well, there is no big scientific reason for that. If you drive on the right, you may meet with accidents. So that's inbuilt in Sri Lanka. So similarly, if you go to some other countries, they may be driving on the right. That country, driving on the right is the value system. Reason is, if you drive on the left, you will meet accidents. So similarly, when it comes to the Islamic finance principles, the value system built is certain industries are not acceptable from an Islamic finance point of view. So what are the implications of that principles is that certain types of industry we cannot fund certain types of industry. We can't give facilities to certain types of industries. So it is, as students of credit management, you will know, in credit policies, we tend to have, in some banks, we tend to have negative list, industries which we won't give funding to. And traditionally, certain industries like gambling are there in this negative list in the credit policy. It's not considered as a industry to give facilities to. That's the policy based on sometimes certain regulations. Sometimes it's a risk reward assessment. It's not the risk reward doesn't match giving facilities to this type of industries. So that's why there is a negative list in our credit policy. So non-permissible activities are the negative list of Islamic banking. Right? But unlike in conventional banking, where this negative list is sometimes regulatory, sometimes it's based on risk-reward assessment or banking practices, the Islamic bank's negative list is based on a value system. As such, even if a big, let's say, top 5 blue chip companies of Sri Lanka go into gambling, go into opening up a gambling den in Colombo, top 5 blue chip companies, then sometimes the conventional bank, looking at the risks and rewards, may take this sector out of the negative list in the credit policy. But Islamic banks cannot do that, because that negative list is based on certain value system, which is not acceptable to Islamic finance. As such, that negative list, at least based on this concept of permissible and non-permissible, is permanent. It cannot be changed. Of course, there could be other negative lists based on risk rewards, that is different. But based on these principles of permissible and non-permissible, certain industries cannot be included in that list. So that's the first principle, permissible and non-permissible. What we mean by non-permissible is any industry, all industries are permissible other than industries which are non-permissible. That's what we mean by the word permissible, the concept of permissible. And what is non-permissible is alcohol, tobacco, certain type of entertainment, weapons, industries like that, which conventional interest-based financial industries, these areas you cannot interact freely. So there is restrictions because it's based on principles. So that is generally the explanation of the first principle, concept of permissible and non-permissible. And non-permissible, you will be able to define 3 or 4 activities under non-permissible, and define permissible as anything other than non-permissible industry is permissible industry. Generally, all sectors of agriculture, all sectors of manufacturing, and large majority of sectors in service sector are acceptable, permissible industries in Islamic finance. So that's the broad principle. So what we have covered is the meaning of these principles and their implication for banks. Implication for banks is that certain industries are treated as negative list in the credit policy. We don't lend to those industries, right? So as treated as restrictive. And no matter what, irrespective, on top of the industries which are put in negative list as based on risk rewards, these are negative lists where you can't accommodate based on value systems. So that's the implication for banking. Number 2, prohibition of interest. The term is riba, Arabic term. Prohibition of interest. So interest is defined in Islamic finance as any excess paid on a loan contract which is conditional to that contract. Any excess paid on a loan contract which is conditional to that contract is defined as riba or interest. So if I give you loan 1,000 rupees, I should get back 1,000 rupees. But if I tell you when you repay, you pay me my capital, which is 1,000 rupees, and 10% more. After 12 months, you pay me 10% more, so you pay me another 100 rupees more. That amount, any excess, means that 100 rupees, the amount we paid more, is treated as interest, which is paid on a loan contract. The 1,000 rupee contract was a loan contract, which is conditional to that contract, which is a condition. When I lent you at the start, I said you have to pay me 10% more. And those are the three elements of definition of interest from Islamic finance side. Any excess paid on a loan contract, excess is the 100 rupees paid on a loan contract, which is 1000 rupees, which is conditional to that contract. When you are initially giving the 1000 rupees, we said we are going to charge 100 rupees more. As such, it is not acceptable in Sharia. Now, what's the implication of this principle? Is that any loan, any conventional loan does not fall within the principles of Sharia. Any conventional loan. So any whether it's fixed interest, floating interest, small percentage of interest, large percentage of interest, none of them are acceptable because of the prohibition of interest. Not only on the asset side, on the liability side, when you accept deposit, either for savings or FDs, because the bank promises to pay a particular rate of interest on that deposit, even that is seen as not acceptable from the Sharia side. So both the deposit side and the advance side of the conventional banking system is not acceptable according to this particular principle of Sharia, that is the prohibition of interest. Because both the advances and the deposits pay an interest, which is pay or receive an interest, which is not acceptable according to the principle number 2. Is that clear? Any questions on that? Right. We move on to the third principle. Third principle is prohibition of uncertainty and gambling. So in these principles, I have given small words, especially small Arabic words, that is used commonly in the industry. Even if you are interacting with customers, sometimes some of these words are used. So people who are in the industry, who are in financial institutions which offer Islamic banking, you may want to remember these words. But for exam purposes, they are not very important, although we will do an exercise on it as we go on. So third principle is prohibition of uncertainty, which means lack of clarity or ambiguity in contracts. Prohibition of uncertainty, which means lack of clarity or ambiguity in contracts. So when we enter into contracts has to have the clear definition of buying and selling the goods, the purchase, the price, the goods, things like that need to be very clearly mentioned. You can't have vague terms in contracts. And when we inbuild vague terms, the rationale is vague terms lead to dispute, which is not easy to solve. As such, creates unnecessary trouble. So when contracts should not lead to uncertainty, contract should be clear. So the example in sale contract would be, let's say somebody goes out of IBSL, gets into a 3-wheeler, and say, I want to go to Rajagiriya. I have to know how much he will charge me before I get into the 3-wheeler. How much, whether it's 200 rupees or 300 rupees or whatever. If the three-wheeler guy says, no, give me something, I get into the three-wheeler, the three-wheeler go and parks in Rajagiriya. He says, give me 500. I says, I'll give you 200. It's not easy to resolve that dispute because we haven't agreed on the price in that contract. If you say per kilometer 60 rupees or per kilometer 80 rupees, then if you measure the kilometer between here and there, then if there is a dispute, easier to solve that. But if there is no clarification on the price, then that dispute becomes difficult to solve. Of course, dispute on the three-wheeler charges can be easier to solve than more complex transaction, especially in financial nature. So as such, prohibition of uncertainty means all terms of contract should be clear, should not be vague, should be clear and mentioned. And that also include parameters of sale. So certain contracts in the modern day financing, such as derivative contracts, such as certain types of contracts, does not fulfill the Sharia principles related to sale, as such fall into this prohibition of uncertainty. And gambling is where your payoff, your return is based on some chance. So if I buy the pen, I pay 10 rupees, I get a pen. That is not gambling, that's a transaction. I pay 10 rupees, I may or may not get a pen. That is gambling, which comes from the uncertainty of receiving the goods while I make the payment. Again, that is also not acceptable in Sharia. So prohibition of uncertainty means to avoid vagueness and lack of clarity in contracts. The implication of that contract, of that principle, is that certain contracts in banking, such as derivatives, is not acceptable, such as forward transactions, such as derivatives, is not acceptable from an Islamic finance point of view. So we have implications for treasury transactions, we have implications for trade transaction under the principles of uncertainty, right, in a conventional banking. Number 4, restriction on sale of debt. So restriction on sale of debt means any debt can be transferred to another party at par value. So if I have an IOU from my friend A, I can transfer it to my friend B at the par value. IOU of 100 rupees from my friend A, I give it to my friend B at 100 rupees. The debt cannot be traded at premium or par value, a premium or discount value. Meaning the IOU for 100 rupees from my friend cannot be sold to my friend B at 90 rupees or 110 rupees. At a premium, 110 rupees, or at a discount at 90 rupees. Because sale at debt is restricted. It is restricted to the extent that it can only be transferred at par value. So what does this imply? This implies certain type of transaction cannot happen, that happens in conventional banking, cannot happen in Islamic banking. Number 1, bills discounting, check discounting, areas like that cannot happen because that will require banks to use par value for transaction of documents, negotiable instruments. Number 2, instruments like treasury bills cannot happen because, again, treasury bills are sold below par, does not carry coupon, zero coupon bonds, cannot be transacted according to these principles. So certain activities of treasury, certain activities of funding, especially related to trade, such as bills and check discounting, cannot happen under the principles of Islamic finance, as it happens in conventional banking. Then the concept for reward for risk. Any return that comes in Islamic banking should be based on some risk related to the underlying assets risk or price risks involved. And in this concept, the credit risk on a loan is not considered. So the reward for risk principle means any return for your investment, any rewards should come on underlying transaction being exposed to a business risk or an asset price risk or commodity price risk, something like that. And the credit risk related to loan transaction is not considered as a risk from a Sharia perspective, because loan transaction is gracious transaction. You give it to people whom are trustworthy, whom you can get back. And even if they are not trustworthy, don't give loan, or you can't expect them to repay, give it in charity. But that is not where the returns are expected. Again, that is connected to prohibition of interest, number 2, which is again connected to our overall philosophy, which we described earlier, the link between financial sector and the real sector. So what does that mean? What I didn't say here is that I didn't say there is no credit risk in Islamic banking. Don't misunderstand that. What I said is, if there is a loan contract, you can't price the credit risk for that contract. All you have to do is get your loan back at par value. So there is no additional risk that can be priced into the loan contracts. Then there is a final notion of justice, fairness, and trusteeship, which means that in all transactions, you should ensure that rights of everybody around are respected and protected. So rights of the stakeholders in transaction are treated fairly and respected, and that whatever the assets we own, we are short-term owners of that assets, and we should leave to people. We should leave all assets that we own to people of next generations, and we should do that in more graceful manner. That's the principle there. Trusteeship means it's again related to sustainability of consumption of investments. Of course, this is a broader principle, not specifics like the other principles I explained. This is a broader kind of generalistic principle. So those are the broad principles. So under the implication of justice, fairness, and trusteeship is that certain activities which are not strictly non-permissible sometimes becomes unfair, can also be ruled out in Islamic finance. So it's not a very specific area, it's a generalist area. And it is up to the Sharia councils to look at and evaluate, and sometimes they question whether certain transactions fall into these principles. So that is broadly the key principles of Islamic finance that we are looking at. When we say Islamic banks are financial intermediaries which operate within the principles of Sharia, when we say principles of Sharia, these are the principles that we are talking about. So although principles of Sharia sounds like it is something that is done in Saudi Arabia or whatever, these are the basic principles that we are talking about. And these, if you very carefully look at these principles, these also represents good banking policies, good banking practices that have been there even in conventional banking in the eras gone by. Some of these principles were there. Um, of course, these are based on values in Islam as such. This cannot be changed too much from entity to entity. The applications are decided by, like I said earlier, the Sharia councils. So they will decide what these principles mean, and how these will also tell us how, using these principles, we can identify the implications for conventional, implications of banking in general, and what are the areas we cannot do in conventional banking. Any questions on that?
Yeah. So,
Yes.
hello. Yeah. And this the number 6. Is
Yes.
that mean that now no, under conventional banking we normally, when we are pricing, we price the we consider the risk associated with that product, the risk based pricing. So is that now under Islamic banking, is it prohibited?
No. So what we say is the rewards that comes from a transaction should be based on the risk associated with that transaction. So risk being considered in pricing is perfectly okay. But what I was saying earlier is that the rewards come from risk related to underlying real sector transaction. So risk related to let's say a sale transaction, risk related to a partnership transaction, risk related to a lease transaction. So those transactions have underlying transaction related to them. And because we are taking some underlying risk in those transactions, the rewards that come is acceptable from an Islamic finance point of view, right? So we can take rewards because we have risks in the underlying transaction. That's the general rule. That's what I explained. But one can try to extend that logic and say, when I give a loan, I'm also exposed to a credit risk. So can't I charge interest for that loan? That principle, that part is not acceptable from Sharia side, because loan cannot earn interest. What you can earn return on is a transaction which is linked to the real sector, like a sale transaction, like a partnership transaction, or like a lease transaction, something like that. You can earn a return. That's what I meant by that. So to answer your question, can we price based on risk? Answer is yes, you can price based on risk. Did I answer the question?
Yeah, it's clear.
Okay. Any other questions? Good. So we have now broadly introduced Islamic banking, covered the broader framework of Islamic banking to understand Islamic banking. And then we have also looked at the key principles related to Islamic banking. So that is our introduction before we go into details of different types of facilities offered by Islamic banks, right? So as long as you are clear about the introduction, what is Islamic banking, what are the principles involved, the rest of the transaction, why we are trying to link them to the real sector activities, will become more clear as we discuss the products, right? If you have any further questions, you're free to ask now before we move on to individual details of facilities. So how we will look at the advanced products is few products for businesses and few products for individuals. We'll try to categorize them like that, and then look at 3 or 4 different products. So each of these products we will look at their definition, how they are structured, or how the process involved, the Sharia principles, the risks associated, the features, the documentation, things like that we will look at very briefly, not the actual documentation, but how it is done, things like that. Or we will discuss general points related to that. And we will move on. That's how it is done. And once we finish every aspect of these products, every area of these products, we will do a question on that product. Let's say first product is partnership. After we finish discussing the partnership, we will do a question on partnership. Right? So once that question, it's worth doing that question very carefully and re-looking at that question, because if you are one of those students who are interested in doing Islamic finance as an optional question in your exam, the question we will choose from this area will be one of those questions, right? So worth looking at that question and doing that, so that one of those questions, not all the questions, one of those questions will come for exam. Again, it won't be the same question, but something similar will come for exam. Okay, anything you all want to clarify at the, related to introduction? Nothing? Okay. Then we will move on to the second part of presentation, where we look at the individual facilities for businesses and individual facilities for individuals. We will look at, facilities for businesses and facilities for individuals. We will look at under different types of financing arrangements. So before I start, I want to explain to you that in general, our basic studies of banking, we have come across, if we are to categorize all loans into only two categories, we can categorize them as one for loans for liquidity purposes, loans for asset financing purposes. That's our basic banking studies we have done during our basic studies. So loan for liquidity purposes and loan for asset financing purposes. And by liquidity, what we mean is to manage mismatches in cash flows, mismatches in liquidity. We need loans, fundings, and then to purchase assets, we need funding. And if I may, I will add to purchase asset financing, to purchase inventories also, because for purposes of Islamic finance, we will consider that also there. So in general, Islamic finance is biased. The standard structures of Islamic finance are biased towards facilitating funding for asset financing, funding for, let's say, working capital requirements related to the working capital cycle of purchasing inventory, processing finding finished goods, selling, and recovering. And less so focused on liquidity products. What I mean by liquidity products is that products like bills discounting, products like overdraft, products like say at individual level, products like pawning. So those are liquidity kind of products, which suddenly you have a mismatch. You go and borrow some money to finance that mismatch. And the standard products of Islamic finance, the standard contracts, are more biased towards the asset financing than the liquidity financing. Why I'm saying that is that any products Islamic banks offer, even if you go in now Sri Lanka, there are 16 institutions that offer Islamic finance. Some of the liquidity products may not be available in all institutions. Some institution will have these products, but not all institutions, because the standard products are not catered to offering liquidity financing requirements, but more towards looking at asset financing requirements. But what Islamic finance practitioners have done is to structure these products, these asset funding requirement products, from a Sharia perspective, even to offer certain level of liquidity requirements. And that is what you will see in the market. That wherever you go, whether locally or overseas, if you look at Islamic finance products, this financing requirement, the liquidity requirement, cash flow mismatch requirement, there will be little less focus there. So I remember personally going somewhere in Middle East and talking about, let's say, pawning. It's a product unheard of in those markets, because maybe that kind of practice is not available there. But similarly, in certain parts, for instance, certain parts of South Asia, that product is available. So in general, the standard structures, what you will see is more facilitative of asset funding products. Having said that, the practitioners have converted these products into liquidity financing products too. From the working capital areas to other areas, they have converted. So those are the general comments on overall facilities. The other comment that I would like to say is that when it comes to Islamic banking, we saw in the framework that we need to incorporate the Sharia aspects, the customer requirements, and the law of the land. So when it comes to credit, the law of the land means our documentation related to Islamic finance should be perfectly acceptable in court of law. For that, so that will also ensure that should also ensure whatever the collateral we take, whatever the securities we take, it should be executable in the court of law. As such, Islamic finance, when it comes to this collateral, takes a general overview, whatever conventionally we take as collateral, the mortgage, the lien, the guarantees, all the other securities that can be taken as collateral under the law of the land, will be used even in Islamic finance as a process of securing the funding arrangement, as a process of securing the loan by the financial institution. So what kind of collateral can be taken? Any kind of collateral that can be taken by the bank can be used by conventional bank, can be used by Islamic bank too. So let me run through these principles and come to that in little more detail. First of all, in terms of purposes, I said Islamic finance will facilitate acquisition of goods and assets more. They have relatively less flexibility to fund liquidity requirements. That's the first point. Number two, the amount of facility will be linked to the underlying transaction that we are talking about. So although even in conventional banking, when we do credit, we will evaluate the business requirement, we will evaluate working capital cycles, we will evaluate the financial situation, and then only lend. That's the general principle. We don't just lend even in conventional banking, anything for everything. But those loans are not directly connected to the underlying transaction. So as such, in Islamic finance, the amount is limited to the underlying transaction or asset, even if the customer is good, even if the customer, we can lend without collateral, even in a AAA customer, still your funding will be limited to underlying transaction or underlying asset, because that stems from the principles we discussed before. In terms of tenor, all types of facilities can be offered: short term, medium term, long term, very long term, whatever the tenor that can be offered. There is no restriction on Islamic finance on that. Pricing can be market based, meaning you can price based on a fixed rate, we can price on floating rate, but not all products offer that flexibility. So some products have fixed pricing. So when we are lending, some products will only, you can't charge anything more. They have fixed product, meaning one is that you can't benchmark it to a floating rate, A. Number two, you can't change the pricing after the tenor. So we will discuss that little more detail in more individual contracts. So pricing is a key consideration that you need to master when it comes to Islamic finance, because it's not like deciding pre-hand it's a 5% facility or 6% facility. There is a little working to be done to arrive at that pricing. We will discuss them as we move on when we do the questions also. Documentation, I discussed documentation and collateral. I discussed them very briefly. Documentation, you need to have the offer letter, security documentation, in addition to if there are specific product related documentation in the contract. Collateral, although I said you can take any collateral that is acceptable from a point of view of the law, what you can recover from the collateral, from crystallizing the collateral, is determined by the underlying product. That point we will discuss as we move on. Whatever you can recover after crystallizing a collateral, meaning selling an asset that was given as security to us. What is the amounts we can take for ourselves? What are the amounts we can take for ourselves is determined by the underlying product. We'll discuss that as we go. Repayment can be any basis. It can be installment, it can be bullet payment, variation of various repayments, but pricing need to be considered in that. In terms of rescheduling, some products have rescheduling possibilities, whereas others don't have that flexibility. So it is again product dependent. You can't say all products can be rescheduled. Neither you can say none of the products can be rescheduled. It depends on products, and again we have to have in mind the related pricing. Right? Those are some of the general concerns, some of the general considerations when we talk about pricing in Islamic finance. When you talk about facilities in Islamic finance. Okay, so with that, we will move on to the first type of product, which is called partnership. Any questions so far? So partnership is one of the key contracts Islamic finance practitioners use to offer financing requirements. And general, when we say partnership, you may think of like a partnership and a partnership law of 1836 or something like that. That's not the case here. Here it's a facility. It's a type of facility offered by Islamic banks on the principles of partnership. So we will look at that on the contract of partnership, not principles. It will look almost like the original contract, partnership contract, but it's a facility. It's not a legal partnership with a company, right? We will look at in general. So when it comes to partnership, we will define a partnership in terms of few variables. First variable being capital, where we say capital is contributed by both the bank and the customer, right? So we identify any business transaction, for instance, if a company wants to buy something, or if a company wants to start up a new project, or if a company wants to enter into a new transaction, the bank and the company and the customer identify area for which funding is required and decide on to invest on it on the basis of principles of partnership, right? So capital for that partnership is contributed by both parties in the sense here, the customer and the bank. So let's say I want to buy. I'm a tea trader. I want to buy 1,000 kilograms of tea, and at 200 rupees, the total amount I need to fund that transaction is 200,000 rupees. Now, that is the transaction that both parties, meaning the bank and the customer, will contribute capital towards. So let's say, for instance, bank puts 100,000 rupees and the customer puts 100,000 rupees together, and the 200,000 rupees is now treated as the capital of the Mushrika, capital of the partnership. And that is used to purchase the tea that customer wants to purchase. So both parties contribute capital. That's the first bullet point. Number two, the profits are shared based on a pre-agreed profit and loss sharing basis. So profits are shared on a pre-agreed profit and profit sharing ratio. Profit sharing ratio is called PSR. PSR, profit sharing ratio. So profits are shared based on profit sharing ratios, which is pre-agreed. Pre-agreed means before the partnership is engaged into, before the partnership starts, the profit sharing ratio is agreed. Profit sharing ratio can be any ratio agreed between people, agreed between partners, in this case, agreed between the customer and the bank. It can be 90-10, it can be 90-10, it can be 15-85, or any other 50-50, any other ratio, as long as it adds up to 100. Yeah, that is the mathematical requirement. Any ratio is acceptable as long as both parties agree to that at the start of the musharaka, at the start of the partnership. So two parties contribute capital, that is the customer and bank, towards the transaction, towards the project, or towards the organization. And both parties contribute capital and agree the profit sharing ratio at the outset. Since we talked about profits, the other part of the transaction is losses. Losses means loss sharing ratio is not equal to profit sharing ratio. Loss is shared based on capital contribution. That's a principle in Islamic finance. Loss is shared based on capital contribution. So if the capital contribution is 50-50, loss will be shared 50-50. You can't agree based on another rate. Loss is always shared based on profit capital contribution. Profit can be shared based on any ratio agreed between parties, but loss is shared based on capital contribution. Then the fourth point is that management of the partnership is given to the customer. The bank does not get involved in the management of the partnership. A fifth point is that dissolution of partnership, or how we conclude the partnership, is normally determined as a time period. For instance, a facility for 3 months means the partnership is for 3 months. Facility is for a transaction means till we sell the underlying goods, it can be a partnership. So that means it can be till let's say customer buys tea, till he sells that in the market, the bank can engage in partnership. So normally it's defined as number of months. It's defined as months. So again, to go through it again, Musharaka is a type of partnership where a facility is given by bank, Islamic bank, where both the customer and bank contributes capital towards a project identified, a transaction, or an organization. Both customer and the bank pre-agree on a profit sharing ratio. It can be 50-50, 90-10, 15-85, whatever the ratio, as long as it adds on to 100. Losses, any losses are shared based on capital transaction, capital contribution ratio. So in our case, if you have 200,000 rupee Musharaka capital, both the bank and the customer contributed 100,000 rupees each. The loss sharing ratio is 50-50. So that is based on the principle of the origins of principles of limited liability. Your liability is limited to your capital, and your liability to share losses are based on your contribution to capital. And then we also said the management of any musharaka is given to customers, so that bank doesn't get involved, like a partnership get involved in management of partnership. And you can end this partnership based on a pre-agreed time period, or something like end of a transaction, something like that. So that is, in a sense, what is meant by a musharaka facility. So instead of bank giving a loan for the customer to purchase, let's say 100,000, 200,000 rupees worth of tea, bank enters into a process called a product called Musharaka Partnership, where bank funds part of it as the capital into the Musharaka. So that's the underlying transaction. That's how it's different from a loan transaction. But
So,
there are more differences. Yes.
So is that Musharaka capital, is that the 200,000 or the amount contributed by the bank? Is the 100,000 as your example?
Yeah, total capital is 200,000.
Is that
the
is
part
that,
of, yeah.
No, I mean the Musharaka capital, is that 200,000 or the 100,000?
Musharaka capital is 200,000.
200,000.
Part of the so capital is contributed by both parties, the bank and the customer. Bank share is 100,000. The customer share is 100,000. So when it comes to losses, this 50-50 ratio, that is 100,000, 100,000, is the ratio on which we share losses. So capital contribution, when we say Musharaka capital, it's the total 200,000 we are referring to. And it can be Musharaka capital of the bank, Musharaka capital of the customer. Right. Is that clear? Anything else we want to clarify? So what we will do is we will break for 10 minutes, maybe 3:25 or something, 10 minutes. How long do you all break normally? How long do you all break?
It's 10 to 15 minutes, yeah.
Right, okay. So 3:25, we'll come back. So let's continue. So what we said is that Musharaka is a type of partnership which is used by Islamic banks to provide financial accommodation, to give facilities to customers. So we will see how that is done using Musharaka in this session. So both parties, meaning the customer and the bank, contribute capital towards the identified transaction, a business, or a project. For instance, in arrow number 1 and 2, let's assume the bank contributes 100,000 rupees and the customer contributes 100,000 rupees to form the capital of the Musharaka here. But at the same time, they also agree on what profits to be shared, whether the profit sharing is 50-50 or 60-40, who is going to get 60, who is going to get 40. That is agreed. So if you write profit sharing ratio, normally we say, let's say 60-40, and next within the brackets we will say 60 for customers. So customer is to bank, meaning 60-40 within brackets customer is to bank means 60% for customer, 40% for the bank. So that is established on under arrow number 1 and 2 along with the capital. Then the transaction happens. Let's say 200,000 rupees. The customer bought 1,000 kilos of tea at 200 rupees a kilogram, and then he sells those tea at, let's say, 300 rupees a kilogram. So, and we assume the profit sharing ratio is 50-50. So the Musharaka, which both parties contribute 100,000 rupees, now has a capital of 200,000 rupees. Using the capital, they bought tea for 200,000 rupees and sold the tea at 300,000 rupees. You have a profit of 100,000 rupees. So project is undertaken for an agreed transaction. Then you have results. The results is 100,000 of profit. The profit sharing ratio is 50-50. The bank get 50% of the profit. So the customer pays the bank 100,000 rupees as its capital and 50,000 rupees as its profit. Customer takes 100,000 rupees as his capital and 50,000 rupees as his profits. So that is the basic transaction on a musharaka, how it could work, the process flow. So if both parties contribute capital, undertake a particular business or project or transaction, based on the transactions, they split the work, the results based on a pre-sharing, profit-sharing arrangement. So instead of giving a loan and charging interest for that loan, the alternative way of giving a facility for the customer is to get into an arrangement of partnership. That's what we are doing here. The Islamic banks does here. And yes.
So how the bank get to know now the pricing? Who is I'm having couple of questions. Number one,
Yes.
who decides the price? In your example T, who decides whether it can be 300,000, 250, and the entire
To be
stock?
sold.
Yeah, to
Price
be
to be
sold.
sold.
Price to be sold. And
Right.
again, it we can't assume that the same price for the entire stock. It can be
Yes.
300, part can be sell at 275, and who decides the price?
Yes.
And the second is, how does the bank get to know what is the exact profit, and how do you segregate the profits as per the profit sharing ratio?
Yes. Okay. So yeah, very good question. Very good question. Actually, we have a question coming up where we will deal with this question. So partnership, when we discuss the partnership's risk, we will answer this question. I'm sorry, I didn't get your name, but shall we do that? We will answer the question that is relating to price, because now when we say profit and loss sharing, the question comes, how do we determine profit or loss? Because we know the cost at least, because both parties contribute capital. But how do we determine profit? What expenses to include? How do we determine the price sale proceeds? And on top of it, do we include the marketing expenses? Do we include let's say taxes? Do we include a provision? So that we will come to that in a minute. It's a very good question. The other question, first question was, how do we determine profit? The other question was,
who decides the price?
Yes, sales price. Okay, that also I will address that when we as we finish. I will address that. If I don't address any part of it, please remind me. But give once we go through the process, I think it will be much clear for you when we discuss the risks and the question. It will be clear for you. I'll come back to that in case I don't finish that. Please raise this question again. I'll answer that. Okay. Right. Okay. Any other questions? So what we are doing here now is that in a conventional bank, I'm going to stop share the screen, and you all can see the board. In conventional bank, yeah, okay. In conventional bank, the bank gives facilities to the customer and customer undertakes the project gives returns to the customer and customer pays returns to the customer pays return. Is that clear? The diagram, is it clear? Conventional bank gives facilities to the customer who undertakes projects, and then the returns on the project is customer takes those projects and he pays the conventional bank. But the returns here, let's say of the 100,000, is, let's say the bank wants 50% interest, and just for the purpose of making this easier, I'm putting that 50,000 rupees, which is our example. That is irrespective of this transaction. Customer investing 200,000 and earning 100,000 profits, irrespective of the real sector transaction, this transaction will be fixed. Of course, when lending facilities to the customer, bank will consider the underlying transaction. Bank will study the underlying transaction. Bank will ask for the purpose. Bank will see the feasibility of this project. But when we lend in conventional banking, we get the return based on the capital and the rate, irrespective of the project's return. Whereas in a Mushrika partnership, which is the diagram on your slide, if the partnership's sales proceeds is, instead of 200,000, 198,000, the profits that will come out is 98,000. Instead of giving 50,000, the customer will give 49,000. In a Islamic banking's Mushrika facility. So the returns is linked to the actual return on the project's profit, not related to the amount given and the percentage agreed. Because what is agreed here in the Islamic banking side is the profit sharing ratio. And based on that ratio, the actual profits is distributed between the bank and the customer. So the difference between the conventional loan, where we give capital and determine the interest, is completely different to the Islamic banking's product of Mushrika, where the returns on Mushrika is in this case, in the slides you all have, in this case, the returns on the Musharaka is determined by activity number 3, which determines how much profit has come. And if we agree 50-50 profit share, the arrows number 4 and 5 are actually based on the actual profits that the customer earned. So in that sense, it is, again, it goes back to our original understanding of the philosophy. It should be linked to the underlying real sector activity. And here, what we are underlying, the real sector activity we are linking is a partnership. Is a partnership of business doing some transaction of trade, tea trade or sugar trade or whatever the trade is, and we link it to the underlying transaction. So we should have a clear idea of how this particular product is different from a conventional product, because its return is generated from the underlying transaction. Okay. So moving on, what we will do is we will go through some Sharia related points. Then we will look at the nuts and bolts of this transaction. We will discuss the risks, and then we will answer the questions that related to this. That's the plan. So what we are telling here is that the Islamic banking facility is somehow different from the conventional banking facility, in the sense the underlying profits or losses are shared rather than a price agreed at the outset. Although both banks will consider the underlying transaction. If you go to a conventional bank and ask for facility, of course, bank will ask what is that you're going to do with that, what's your purpose, how is that project looking, what kind of profits you can make from that, all that will be evaluated. But the link to actual profits is what this Musharaka arrangement establishes in Islamic banking. So there are few rules related to Islamic banking when it comes to Musharaka. First is that this is, of course, coming from the principles. So let me illustrate this also. I will. This is Islamic Bank. This is the project. This is customer. So customer contributes 100,000 rupees. Islamic Bank contributes 100,000 rupees. Project is to buy something at 100,000, 200,000 rupees, right? 200 kilograms at 1,000 rupees tea. 1,000 kilograms at 200 rupees, and then sell at 300 rupees 1,000 kilograms. 300 rupees, right? So The profit is 100,000 rupees. PSR agreed at the initial stage is 50-50. So customer and bank takes 150, 150. Right? This is what we just discussed. But let's say instead of this 300, he gets a price of 290. 290 instead of 300. The sales proceeds will become 290,000. And the profit on the project becomes 90,000, and the payments will be 145. But in a conventional bank, that doesn't matter. Assuming this is a 50% loan, conventional bank gives it 100 rupees. The customer has to pay 150,000 more, irrespective of the real sector activity. Now, this part is the real sector activity. The real sector activity, and this part is the financial sector activity. In conventional bank, the financial sector activity only remains. It's not directly connected to the real sector activity. Because it is not directly connected to the real sector activity, the returns won't change based on the real sector activity. But here is another question. Instead of 200, he sells at 190. What happens then? He incurs a loss. The loss also will get passed on to the Islamic bank. So let me now move back to the slides. So the first point here is the guarantee is not the security guarantee that we are talking about. There is Islamic banks accept guarantee on Musharaka. That is perfectly all right. But here what it means is you can't give a guarantee saying in case of losses, we will make good that losses. Let's say in our case, we can't give a guarantee saying in case there is a loss, we will ensure you get paid your 100,000 rupees. Because that guarantee is against the spirit of the product. Product is profit and loss sharing. And if there is a guarantee given saying in case of losses, we will pay you back your capital, that violates the spirit of the underlying product. As such, it's not permissible. So that is a Sharia rule related to Musharaka, related to this particular product, where what I'm saying is, I'm not saying it is not permissible to get a guarantee in Musharaka. You can get a guarantee. But what you can't do is you can't say in case of capital, or the bank can't claim the cost, the original capital, despite a loss. So if there is a loss, bank can only claim the net amount. So if there is a loss of 10,000 rupees that bank has to bear, bank can only claim 90,000 rupees under the guarantee if the customer doesn't pay. Bank can't be made good. Bank can't use the guarantee to make good its losses under Musharaka. Number two, there is a dual profit sharing mechanism. Now, I introduced a 50-50 profit sharing mechanism. Now, that if we work back, could lead to very high profit being distributed by the customer to the bank on a regular course of business. So in this case, if this is a 1-year facility, customer ends up paying 50%, which is way high. So generally customer will agree especially in other countries. In Sri Lanka, still we don't use dual profit sharing system. In other countries, a customer will agree two-tier profits up to a certain level. Let's say 20,000 rupee profit up to 20,000 rupees profit. The profit sharing will be 50-50. Anything beyond 20,000 rupees, the profit sharing will be 99 for the customer and 1% for the bank, or 99.9 for the customer and 0.1 for the bank, something like that. So that customer puts more or less a cap on the total profit the bank can earn. So there are practices like that happens in rest of the world. So dual profit sharing system means to agree profit sharing to different profit sharing ratios based on the quantum or magnitude of the profits. So two profit sharing ratios can be agreed so that majority of profits will go to the customer and bank gets back what its real required rate of return on this product is. So bank has expected rate on a particular funding. As long as bank gets that rate, it's not interested in any windfall profits of the customer. So that in order to maintain the relationship, bank will give back anything beyond its expected return as profits to the customer. So that's the general practice in Islamic banking. So the rates are more or less comparable when you work back to the conventional bank's rate, more or less comparable. So that structure is done to ensure, of course, this dual profit sharing is not practiced much in Sri Lanka. Then the third point is that I spoke of capital being contributed by the customer and the bank, but sometimes customer doesn't contribute capital in kind. Sometimes customer does not contribute capital in cash. He contributes in kind, meaning goods and services. At an organization level, Musharaka, the shareholders' funds of the customer is treated as capital. So Musharaka can be at a transaction level, like what we discussed, to buy 1,000 kilos of tea. It can be at a project level, as in customer has 5 projects, A, B, C, D, E. Project E only, bank and customer forms a partnership. So it can be at project level or at transaction level. Any of these transactions, if customer already has assets, that can be treated as capital, customer's capital, based on agreement, mutual agreement with both parties on the value of those assets, right? So amendments of PSR. So PSR, I said, is agreed at the onset, 50-50 in our case. We agree at the outset of the transaction. If for whatever reason it needs to be amended, it can only be amended with mutual agreement, meaning both parties have to agree to amend the PSR. Otherwise, it cannot be amended. So both parties agree, let's say amend Musharaka profit share, that can be done. So those are some of the Sharia aspects that you need to remember on top of the key features what we talked about in terms of capital, profits, losses, management, and the closure of Musharaka. Any other question? Any questions on them? So what we have discussed? Okay. So in terms of purposes, So we will look at the nuts and bolts quickly on Musharaka in terms of purpose. This is offered to high-end corporate segment. Transaction level Musharaka is considered for mid and SME corporates. Why is that? Now, I think this was the question previously raised also. When we said profits, this will come under risk also. But I will start discussing it now. When we say, first of all, Musharaka is for business purposes, other than one deviation, which we will discuss, called diminishing Musharaka. Musharaka is for the businesses, and we share profits and losses. So profits and losses need to be calculated. And for that, it has to be calculated in a reliable way acceptable to the bank. So if you want to give any facilities on Musharaka, you have to give to customers whose profits or losses can be calculated in a reliable way. Either based on reliable financial statements or based on some reliable records. If the customer has three sets of accounts and three sets of profits and losses, which profits to share will become a question. What cost to be taken into consideration will become a question. And those questions are not easy to resolve. So before getting into a Musharaka agreement, it is very important to determine how is profit defined. Profit defined at gross level, profit defined at operating profit level, profit defined at net profit level, profit defined as EBIT, EBITDA, or whatever. That needs to be determined first before to start with. What are the expenses that are included? What are the expenses not considered in deciding profit? That needs to be considered. Very basic is sales minus purchases or sales minus cost of sales. That is the very basic cost that you will look at to arrive at a gross profit. As long as that basis is not established correctly, and the relevant documentation, the relevant financials is not available, it will become difficult to determine profits. So the question about who determines profits, the customer, of course, have to report profits, but the profit reporting or calculating methodology is clearly established. So it is easy for the banks to establish a methodology with profit calculation with corporates, especially high-end corporates, who are listed, who have regular financial statements, reviewed quarterly, audited annually, all that. It's easier to establish the profit and loss sharing profits related to that. Or reviewed by auditors on monthly basis, quarterly basis or something. If you have a financial statement where profits and losses are calculated quarterly, so those are easier to establish. When it comes to mid corporates or SMEs, that becomes little more difficult to establish profits. As such, instead of an organizational profit, the Islamic banks moves into transactional profit. Particular transaction, the purchase price, sales price, establishing the difference. So in those instances, sales, for instance, in our case, let's say T-Trader, if you want to establish profits on T-Trader, you may want to establish a T-auction sale document or something like that. So the sale, the document from a third party establishing a sale, if it's a product that is exchanged, or if you have a maximum retail price on a goods, then based on that, some kind of establishing price is required if you are looking at mid or SME kind of transaction. It becomes very critical. So it's very important to establish that profits. Otherwise, the question of what is profits will bring up. So in some musharaka agreements, the calculation is very clearly mentioned. Profit will be shared based on this ratio, and we mean by profit is the total sales proceeds minus these costs, plus these whatever, and then you arrive at profits. That is mentioned, and this will be reviewed or audited by so and so by this time of period or something like that. So ideally, this is one of the very riskiest product in Islamic banking. As such, generally, it is the customer segment we look at is more high-end corporates, listed companies, conglomerates with regular financial reporting to head offices elsewhere, areas like that. Right. So the purpose is for business. So you won't see. We will discuss little more when we look at the risks under this purpose transaction, but purpose is also for business, I said. Other than one variation of musharaka, which is called diminishing musharaka, which is used for housing, which if we have time, we will discuss that. Most of the musharaka is for business purposes. Amount on transaction level musharaka is limited by the amount of underlying transaction. Even on other musharakas, underlying asset involved defines or limits the amount of financing that can be offered. Tenure is normally short term and linked to underlying transaction, because very long term musharaka becomes little difficult to calculate profit losses and all that. So generally tend to be short term, but it can be offered for long term. But generally, in practice, it tends to be short term. Profit pricing is based on PSR. PSR stands for profit sharing ratio linked to expected returns. We will discuss that a little more. And it's market based. So if the bank has a facility for getting AAA customers, 1 year facility of 6% returns, that will be benchmarked to the PSR. PSR will be in 50-50 or 60-60 ratio, but bank's expected return will be in a percentage, and it is up to the relationship manager and credit team to ensure the PSR proposed is linked to expected returns. We will see how to do that as we move on. But PSR is not just determined based on what you feel like, 50-50 or something like that. PSR is determined by looking at the expected return for the type of facility, for the type of customer, based on the collateral offered. We will have a rating, for that tenor of facility. What is the expected rates? That rate will be used as a basis to arrive at the PSR. We will see that as we go on. So that normally that rate for this type of customers, for this type of facility, for this type of, let's say, collateral, for this type of tenor, we will want X percentage. That will be established by Treasury, or head office will send it to the branches, or Treasury will send it to the various divisions, or that pricing sheet will be the guiding sheet. That will be in percentage. That is benchmarked to Treasury bills or Treasury bonds or average prime lending rate or something like that. Looking at that rate, it is up to the CRM to structure the musharaka in such a way, or work out the musharaka PSR, so that the expected return will come more or less based on the Musharaka terms. So actual return will be based on the realized performance of Musharaka, but the CRM, the bank, will work out based on its expected returns, a PSR which will give bank similar return as what it is expecting. Documentation, standard documentation such as the you will have the offer letters, you will have all the collateral, all the security documentation. On top of it, you will have the product documentation also in a Musharaka. You can take any type of collateral in a Musharaka. You can take a clean, you can give it clean, you can take guarantee, you can take mortgage, you can have lien or something. All type is possible. But amounts recovered has to be what is due. Amounts recovered has to be what is due. What do I mean by that? In our case, if the customer loses, instead of 300,000, customer only sells the goods at, let's say, 190,000. All the goods are sold at 190,000. There will be a loss of 10,000 rupees. And that 10,000 rupees should be borne by customer and the bank at a capital contribution ratio, which is 50-50 in this case. So instead of, so the 5,000 rupee loss will come to the bank. So if the bank is going to, let's say customer didn't pay this facility and bank is going to recover it, it sells his property, it cannot recover more than 95,000 rupees because the 5,000 rupee loss is written off the capital. Loss is nothing but loss of capital. So when loss is written off, the balance only bank can claim plus any other actual costs related to recovery. Repayment can be short-term, bullet payments, or profits only and capital at maturity, whatever way that need can be structured. Rescheduling is possible. Of course, you can't charge penal rates or anything like that, but you can charge. You can reschedule a facility for Musharaka as long as underlying transaction continues to incur profit. It can be rescheduled. So having explained that, we say three things when it comes to Musharaka. Choose the right customer, choose the right project even from the right customer, and choose the right timing. Right customer, right project or transaction, and right timing. Let me explain that. First of all, right customer, we have to determine customers whose financials are reliable to ensure we get our profits and profits and capital back. So in order to do that, it's always good to go with our customers whose financial are reliable. Where the reliability of financials become questionable, it is difficult to establish profitability. Even with large customers, sometimes some supporting documents to arrive at establishing profits is sometimes used. So, such as some documentation which will support the actual calculation of profits is used, right? So the asset class that we are going to invest in, that's where the discussion comes to ensure there is no high risk when we are exiting. So the capital, there is a requirement in Musharaka that when we exit, we have to value our assets at market value. But in a short term, it doesn't change much. As such, it is not required. But if the prices change very, very volatile, then this can come to hurt us. As such, we have to invest, we have to look at assets which are more stable in prices, and especially if it is short term, then that risk is minimized. Number two, even on the right customer, let's say has 5 projects. Let's say customer has 5 projects, A, B, C, D, and E. He makes profits in A, B, and C, and D, but E, he makes losses. And smart customers sometimes come to the bank and say he wants to do a musharaka on project E only. Because customer is high profile, large customer, if you go and get into musharaka on project E only, customer will then lecture you the principles of musharaka, because on principles of musharaka, once you agree the project, whatever the losses come, losses need to be shared based on capital contribution. So the bank will end up bearing losses, which is not very, very funny for the customer relationship manager or the credit team involved. So it is very important to identify the right project, even with the right customer, because some projects segments may be making losses, whereas overall the company making profits. So if you define the project scope into a specific project which is making losses, invariably the Sharia team will say you have to only share profits related to musharaka, meaning you will end up sharing losses. As such, even right customer, you have to select the right project or right transaction. And then third, in case there are cyclical nature of business, a company which makes profits for first quarter, third quarter, and fourth quarter, but makes a loss in third quarter, if you enter into musharaka only during third quarter, chances are you will lose money, because third quarter is bad quarter for that particular company, because its business is cyclical in nature. Let's say you enter into a musharaka with a hydropower company, and let's assume the third quarter is the second quarter is a dry quarter for the company. It makes losses. It doesn't generate enough revenue during that quarter. But you have agreed that you will share profits and losses during only second quarter. Chances are you will end up sharing losses during the second quarter. So the quarter in discussion, if the company makes losses, that losses gets passed on. As such, it's good to, in case like that, it is good to extend the musharaka for a longer period to minimize risks, or avoid the loss-making quarter and go into quarters which are more profit-making. But cyclicality will become an issue, especially needs to be considered by credit in case of transaction like that. So not only that you have to look at reliable financials, you have to also look at the trends of profits over a period of time to see whether there are any cyclical nature of business is there.
Sir.
Yes.
In a musharaka,
Yes.
When after investing the bank, say the same example, say the tea.
Yes.
Now the bank sees that the tea prices are going down.
Yes.
minimizing the loss, is there any possibility of the bank to propose the customer to sell that stock? Rather, the waiting, the customer might have a different view that the prices will pick up, but the
Yeah.
bank in a different opinion that the prices further goes down. So in minimizing losses, is there any possibility for the bank to make any comment or the proposal to the customer?
Yes, that can be incorporated in standard. Like I said at the outset, the management of business, we generally give it to the customer. But if so, that means bank has a bank also claims some expertise in tea prices. No, if we are capable of, let's say, we are in banking, if you are capable of taking a view on tea prices, of course you would want to have some clauses on how to determine something. But you can, like in like a margin trading, like you can also have a like a cut loss limit at, if the goods at any point of view goes beyond that, customer has to sell or something like that also you can put. But expertise is different from having a cut loss. Cut loss in the sense, beyond this we won't absorb any losses, customer will sell or something like that. So those can be incorporated, but normally we won't have expertise in all the areas customer will have, in terms of estimating that price. But as a risk mitigant, maybe we can have some kind of a loss limiting, loss, some kind of a clause to limit our losses. That can be done. Clear?
Yeah.
Okay. So good. So those are the broad parameters. So what we have done is, once we have defined the Islamic banking, now we have gone into Islamic banking products. The first product that we discussed is Musharaka, which is a partnership. Where what we have seen so far is that, unlike a conventional bank giving a loan and charging interest, you can create similar arrangement of funding the customer using a partnership agreement, which using a musharaka. But that musharaka transaction creates in itself its own features of risks and returns. How it is priced, what kind of risk bank takes, is different from a conventional loan that we give normally and charge an interest. Although in both cases, customer will be engaging in the same business, in this case, in Islamic banking case, since we are connected to the real activity, it creates little more scrutiny into the underlying business involved. Because unless you are very sure that this case is worth lending, you won't go into a musharaka, because you will end up sharing profits and losses. Whereas in conventional banking also, we won't go into businesses which we are not sure of, but we have some protection irrespective of the actual business activity. Our capital and the interest are actually contractually at least protected, contractually at least protected. And we will, in addition, seek further support from the collateral, so that there is general support to conduct business. But what I didn't say so far is, this is not the only contract bank has. This is perhaps the most riskiest contract Islamic bank has. As such, Islamic banks choose their customer, choose which project to, or which transaction to, or which business segment to fund, and they also look at very carefully the time variability, any seasonality in the project before going into Musharaka, right? So that's what we said. So in essence, Musharaka is different from a conventional loan and changing the name from interest to profit, right? That's also sometimes misconception. Instead of changing, instead of charging 10% interest, just put 10% profit and charge. That's also sometimes common among the conventional bankers. And that's not true. The underlying transaction is totally different. Just terminology changing will be much easier. But here we need to consider the underlying risks involved for the bank before going in for Islamic financing. Because if you are not familiar with what you are dealing with, bank will be exposed to higher risk than a conventional lending. So those are the common features of Musharaka. Any questions? Any one of you all have any further questions? I think I clarified the question raised earlier about the pricing and calculation of profit or calculation of profit. Any further questions you all have? No questions? So what we will do is it's 17 minutes after 4. So another 10 minutes or 10 to 12 minutes maybe. If you all can do this question, this is not available on your slide which you have. Of course, you can take a screenshot, but if you all can work out this question first, then maybe I will try to do this on the board. But before that, can you all first take 10, 12 minutes and finish, try answer this question? Okay, everybody has done. Right, let's go through the question. So first of all, it makes sense to do these questions and see, essentially because this is what you will get, something similar only you will get for exam purposes. So it makes sense to practice questions like this. In addition to little writing, which can ask about general items like what is Islamic banking and related, like a theory. We will also look at the specific calculations, something like this, to arrive at calculations related to Islamic banking. So if we practice these, something similar only will come for the final exam. But of course, it's an optional area. If you want to do, you can try this. Otherwise, there is another option that you can look at. Right. So let me read the question. So I will stop sharing screen and do it on the board. So if you have any discussions, you can unmute and ask me anything, clarifications. So the question here is that Mr. Niroshan is a registered tea trader dealing in the Colombo tea auction, right? At the next Wednesday's tea auction, he is planning to buy 200 kilograms of tea at rupees 300 per kilogram. So the customer is planning to buy 2,000 kilograms of tea at 300 rupees per kilogram. he has 200,000 rupees in cash for this purpose and needs funding for the balance. So that's important information. First of all, 2,000 kilograms of tea at 300 rupees per kilogram. So that is 600,000 rupees is Musharaka capital. Can you all see this? Musharaka capital, 600,000. How did I arrive at it? This is the total purchase. This is a transaction Musharaka, meaning we are trying to do a transaction Musharaka for Musharaka for a particular transaction. So that is 200,000 200,000 rupees, 2,000 kilograms into 300 rupees, 600 kilograms, 600,000 rupees. That's the total amount of funding required. He has 200,000 rupees and in cash for this purpose and needs funding for the balance. So out of this 600,000, the customer has 200,000 rupees. So this is customer's capital and he is expecting bank to infuse 400,000 rupees. That's the capital split. Customer, bank. He approaches an Islamic bank for a Musharaka facility, claiming that he expects to resell the tea at 360 rupees in 3 months. So he has a expected reselling price of 360, but he says it will take 3 months to sell this tea. Bank is ready to grant a Musharaka facility for 400,000 rupees. So bank is okay to give this facility for 3 months. 3 months on a PSR. Now notice here in this question, the word PSR is only mentioned, right? It doesn't refer to profit sharing ratio anywhere. So question could be, what do you understand by PSR also to start with, right? Doesn't define. So better to be familiar with these terms. PSR means profit sharing ratio. Also Musharaka. Now since we have just done Musharaka, which is a partnership, the title says partnership Musharaka, you will be familiar now, but closer to the examination. And we have few more products starting with M. You may not remember the term Musharaka. As such, it's good to remember these terminologies at times, right? So first question is, what do you understand by a Musharaka facility offered by an Islamic bank? For this, you have to write a very few basic sentences. The definition is already there in the previous slides. You can write it's a advanced product offered by Islamic banks based on the principles of profit and loss sharing. And then you can say it's a partnership. It's a type of partnership offered by Islamic banks. Then you can say about capital, about the profits, about the losses, about how it is managed, and then about the tenor of Musharaka. Something like that will be a complete answer. All right. So minimum, since we are only discussing lending products, you can easily say it's a lending product offered by Islamic Bank, at least the very minimum, bare minimum. But a broader discussion will get you complete marks related to that. So that's the first one on the discussion point. So if this question is to come, maybe we will add what do you understand by PSR. Then you have to say PSR stands for profit sharing ratio. In a Mushrika, in a partnership, profit sharing ratio is predetermined or pre-agreed between the partners, and it is generally not changed unless both partners agreed, something like that. Right. So these are like the questions that you will answer related to concepts that we are discussing. Number 2, calculate the PSR to be proposed to the customer. Calculate the PSR to be proposed to the customer, assuming the expected selling price given by Mr. Niroshan, that is the customer, is reliable and bank requires 18% per annum return on this facility. Now is the skill of how to calculate the PSR, that is profit sharing ratio. How do we propose to the customer? How do we calculate? That's the question here. So how do we calculate? First of all, we need to understand what is bank's required return on this facility. That's the first thing. How do we establish that? Normally, the treasury will send you a pricing sheet, or your head office will send you a pricing sheet which carries the pricing expectation of different types of facilities for different customers with different types of tenor, different types of securities. So based on that pricing sheets, you agree, you figure out what kind of customer rating this particular customer has, and what kind of security is offering, or blah blah blah. You come up with the pricing relevant to him. So this question actually tells you, according to this customer, the relevant pricing 18% per annum. So that's our start. So bank is going to fund for 3 months, and the rate it's going to use is 18%. So bank is expecting a return from this facility. How much? 400,000 into 18%. 400,000 into 18% into 3 divided by 12. That's the tenor. How much does it work out to?
6,000.
6,000, huh? 400,000, no, can't be, it has to be a little more, I think. 400,000 into 18% into 3 over 12. How much does it? Is it 6,000? Any other answers? I'm getting 18,000. Is that anybody else is getting that answer? Nobody has done this?
Yes, 18,000.
18,000, that is right?
Yeah.
So this is the expected returns, total profit the Islamic Bank is expecting for this transaction. First, we establish that, right? That's the first point. 400,000, how did I arrive at it? Bank is going to fund 400,000. The rate is 18% and the tenor is 3 months. So this is not Islamic banking calculation. Any of you all will be able to make this calculation. If we give for this period, this amount for this period at this rate, what is that we are expecting? So it's basically even simple interest calculation is what we have done. All right. So we start with that. But the question is to propose to the customer, calculate the PSR to be proposed to the customer, assuming the expected selling price given by Mr. Niroshan is reliable. Now, Mr. Niroshan told us he is buying 2000 kilograms of tea at 300 and he can sell them at what price? What price can he sell them at? 360. Is that clear? So he can sell them at 720,000. Correct? But the goods he is buying at 600,000 rupees, he can sell them at 720,000 rupees. That's what he is telling. And that he can do in 3 months. That's what he's claiming. Now, the question is telling us, calculate the PSR to be proposed to the customer, assuming the expected selling price given by Mr. Niroshan is reliable. So this information is reliable. You can trust him on this. If he says 360, he will be able to sell at 360. So if that's the case, calculate the PSR to be proposed. So we need 18,000 of this 720,000. So what we do is 18 divided by 720,000. How much does it come to? How much does it come to? I gave you all time to do the question so that you will tell me the answers. 2.5%, is that right? Sorry, my mistake. Not 720,000. 720,000 is the sales proceeds. What's the profit? Profit you can calculate 2 ways. The original cost is 600,000. Sales proceed is 720,000. So profit is 120,000. Or 360 minus 300 into 2,000. Both leads to the profit of 120,000. Yeah. So expected profit on this transaction is 120,000. That is the expected profit. And of this, we want 18,000 rupees profit, which means 18,000 divided by 120,000. How much does it work out to?
15%.
15%.
Yeah.
Right. So 15% is our PSR, meaning 15% of this profit. So the PSR to be proposed is 15% to 85% bank to customer. Can you all see this side? PSR to be proposed is 15 to 85 bank to customer. 15% for the bank, 85% for the customer. How did I arrive at that? Let me go back again. Musharaka capital is 2,000 kilograms of tea that he wants to purchase at 300 rupees, which is 600,000 rupees. He is contributing 200,000 rupees of that. Bank is contributing 400,000 rupees of that. So together is the Musharaka capital. So first we establish that who is contributing how much in capital. Now, second step is bank is contributing 400,000 for 3 months. How did I get 3 months? Already question says he expects to sell in 3 months and that is acceptable for the bank. That is reliable. Let's assume that is reliable. And it says bank expects a return of something like 18% for a facility like this. 18% for a facility like this. 18% per annum. So in order to arrive at the total expected profit will be 400,000. That is our funding amount. The expected rate is 18%. The tenor is 3 months. We arrived at the total profit bank will be expecting is 18,000 rupees. We are working out the absolute profit. We will expect if we fund 400,000 rupees to start with. Then we calculate what is the profit on this transaction, total transaction. So of the transaction, if we calculate the total profit, and if we know what profit we want, we know what profit we will propose to the customer, then we can split that. So how do we calculate the total profit? 2,000 kilograms bought at 600,000 rupees. That's the cost of sales. 2,000 kilograms sold at 360, which is 720,000 rupees. That is the sales proceeds. Sale minus cost of sales, which is 120,000 rupees, which is the profit of the Musharaka. Meaning entire 600,000 rupee worth of tea has been sold at 720,000, which gives us a profit of 120,000 rupees. Now, expected profit, this is. The expected profit of 120,000 rupees, we need 18,000 rupees. So what's the share of profit we need? We need 15%. And the customer can take 85%. So the profit sharing ratio is 15 to the bank and 85 to the customer. That's how we arrived at the proposed profit sharing ratio. Is that clear? Any questions on that? Did you all get this right? Did you all get 1585? Where was the mistake? What was not clear? Anything you want to clarify?
Now the 18,000 the bank expects after 3 months.
Yes, that's right.
If the customer sells this stock within 1 month, is that mean that the bank is getting the time value of that 18,000? Because the bank is receiving the return
yes,
than the expected tenor.
Yes, it's getting its return faster. So if it comes in 1 month, the bank will get the same returns because that won't change. But bank will on a case by case basis decide how to charge that. How to charge so much. So if the customer says he wants a facility for 3 months and comes and pays early, there are two considerations. One is he hasn't utilized for the full time, so maybe we can give something back instead of this tenor 3 months. Tenor becomes 2 months, correct? But we agree this tenor and the profit share to start with. So after agreeing the profit share, a customer comes back and says, no, now it's 2 months. The profit share hasn't changed. We are taking all this into consideration before the start of the project. So it is on a case by case. Bank may, to maintain customer relationship, may refund. So that is number one, consideration number one. Number two, if customers come and settle, that creates what is called a pre-settlement risk. So bank will consider that also. So if he comes back in 2 months, the answer won't be 2 divided by 12. It will be something between 2 and 3 divided by 12. That will be the rough answer, because it's considering both the tenor, reduction of tenor, and of course it's also considering something for pre-settlement, because he told it will take 3 months and we are assuming it's reliable only, we are going in this. Okay, is that understood? How the 80, now the question is, how did we come at 1585? So this PSR is proposed at the outset, at the start of the transaction. Is that clear? So first thing is, you should be able to calculate that. How do we calculate that? It's not just say 50-50, not like that. It is based on an expected rate. This 18% is critical here. That's the expected rate we use to arrive at the PSR. That's a percentage. That is benchmarked to treasury bill and bond of similar nature, or that takes into consideration the tenor of the facility, the customer's risk credit score in terms of whatever score he has, a AAA to C or whatever that has, depending on the type of collateral. All that is considered, currency, all that is considered, and this rate is given. Once this rate is given, we are trying to arrive at a PSR based on the information at hand in terms of forecasted profits and sales. We arrive at that rate. So this is how PSR is arrived. That's what we are trying to establish here. Once PSR is established, different types of sales will generate different types of profits and losses. Those are the questions beyond this, right? But first we need to understand how is PSR established. Is that clear? Any questions? Okay, we'll move to the next question. What will be the profits? What will be the profits due to each party if 1,500 kilograms of tea are sold at 370 and 500 kilograms of tea is sold at 380, and the agreed PSR is 80-20? So we have new information, but before I go on, anybody who has already done this, can you all tell me the answer? I will just note down before we move on. The question is sold, what will be the profits due to each party? Profits due to customer and bank. Can somebody tell me the answer? We will check. I won't hold you responsible. Don't worry.
28,000 for bank.
How much? 200
28,000.
228,000 for the bank. And
112 to customer.
bank gets 228,000.
No, 28,000.
28,000. Okay. Yeah. And 112,000 to the customer. Is that right?
Yes.
Okay. And any other answers? Anybody else want to try an answer? It's a democracy. You can have different types of answers. No? Okay, let's work out. Thank you for that. So we have calculated the PSR to be proposed to the customers. What will be the profits due to each party if 1,500 kilograms. So we bought 2,000 kilograms. 1,500 kilograms are sold at 1,500 at 370. 370. And 500 kilograms is sold at 380. So first we'll arrive at the total sales proceeds, or we can arrive at the total profits. How 1,500 into 70 is 000.
450,000.
Sorry. 000. 15 into 7 is 70. 85.
105,000. Yeah.
105.
Yeah.
That is 550,000.
So 70 rupees into 15,000. Yeah, sorry. I'm calculating only the profits. I will calculate only the profits. So what I will do is 000. 105. Yes. 70, 35, 105. Yes. 00040. Altogether, the total profit is 145,000. Is that right?
Yeah.
So 2,000 kilograms, we earned a total profit of 145,000. How did I get that? I knew our cost is 300. When you sell at 370, you are getting 70 rupees a kilogram profit. When you are selling at 380, you are getting 80 kilograms, 80 rupees a kilogram profit. So for 2,000 kilos, we are getting 145,000. That's the total profit. And profit sharing ratio agreed is, according to the question, 80-20. 80% for the customer, 20% for the bank. So 20% of this is 14,500, 29,000. Is that right? Am I calculating right?
Yeah. 116,000. 16,000.
116, 130, 145. So this is almost right, but I think the 80-20, right? Yes. Now here the question tells us what rate to use, right? Earlier we calculated the rate to be used based on the profit sharing ratio, right? Now question doesn't use that ratio, obviously, because some smart people will try to use this ratio as the answer for the first question, right? So question gives another ratio, which is 80-20, which is different from our previous calculation, which was 85-15. Is that right? So question gives another ratio and says, now distribute this profit, calculate and distribute profit according to the new ratio. If you do that, we will get 116,000 and 29,000, right? So what is important is you try, because this is the first time you are doing Mushrika, you try and realize where the ropes are, so that actual exam question when it comes, you will know where we could go wrong, right? That's the most important thing. Not to get it right now. No problems at all. You can get it wrong. Because this is the first time you are exposed to a Musharaka calculation. But if you do that and practice, when it comes to exams, it will be cakewalk. You will do it very easily and you can score the marks. Because the underlying mathematics is very simple. There is no big, calculus and integration here. It's just very simple mathematics. As long as you can do that and you understand the transaction, you will be able to easily score marks. So that's the question on number 3C. Number 4, calculate the loss for the bank and customer if 2000 kilograms of tea is sold at 280 and the agreed PSR is 80/20. So can I also have an answer for this before I start, please? Answer for customer, what is the question?
32,000.
Loss for the bank, just a minute. Calculate the loss for the bank and customer, okay? Bank how much? Customer how much?
Bank 8,000.
Bank 8,000.
Customer 32,000.
32,000. Is this correct? Bank 8,000 and customer 32,000?
Yes.
Okay. Any other answers?
Customer 13,320.
Customer 13,320.
Bank 26,680.
26,000?
680.
680. Have I got your numbers right? Bank 26,680. Customer 13,320.
Yeah.
Okay. Any other answers? Okay, only 2 candidates, huh? Right. So the very important is to try this so that your own where you are going wrong, you can check, and that helps you to rectify it as you go on, right? But if you don't try to audit my calculations, it's good. I have people to audit my calculation, but that doesn't help you to remember for exams, right? Of course, you can practice and become good at it. That's good, but at least this answering yourself, it's always very good. Okay, Musharaka, the question is calculate the loss for the bank and customer if 2,000 kilograms of tea is sold at 2,000 kilograms of tea is sold at 280 rupees. So what are you going to calculate? The loss. Loss is calculated based on what? 20 rupees loss per kilogram. So 40,000 rupees loss. That's the first thing. Have you got the loss right? So both these answers have got the loss right. Right? Total loss is 40,000. Now, what's the profit sharing ratio? 80/20. Are you going to distribute based on the profit sharing ratio?
No.
No. Why is that?
Because we have to depend on the capital contribution.
Yes, that's right. Profit sharing ratio is to distribute profits. So that's why it's called PSR. Loss sharing ratio is not specifically said. Profit in general, in sometimes in conventional partnerships, profit and loss sharing ratio is same. Whereas here, profit and loss sharing ratio is not same. Profit sharing ratio is separate. Loss sharing ratio is not negotiated. It is calculated based on the capital contribution. So how we do that is first we can calculate the capital contribution. Capital contribution by the bank is 400,000 and by the customer is 200,000. So the ratio is, this has to be split between 2 divided by 6 and 4 divided by 6, 4 being the bank, 2 being the customer. Is that clear why I have done this? First I calculated the loss, which is 20 rupees per kilogram, right? Because we bought at 300 per kilogram and we are selling at 280. So we are losing 20 rupees per kilogram. So total we have 40,000 kilograms, 40,000 rupees loss. That 40,000 rupees loss, how do I share? Not based on PSR, not based on PSR, but based on capital contribution. So this is what I said when we talked about Musharaka. We said capital, both parties contribute, profits based on a PSR, pre-agreed. Losses, we said based on capital contribution. That's what we said about losses. And this is loss, so we use the capital contribution. So 200 and 400 are the capital contribution, 200 being from customer, 400 being from the bank, together 600. So without doing the full calculation, I will take 2 divided by 6 and 4 divided by 6. 4 is for bank, 2 is for customer. So this is 1/3 of 40,000 is 13,333. Is this right? Is this right? 40,000, 1/3 of 40,000 is this, and 2/3 is that right? Am I going wrong anywhere? Is this right? No answers, please. So 40,000 loss, 1/3 of 40,000 is 13. 1/3 of 30,000 is 10,000. 1/3 of 1,000 is 1/3 of 30,000 is 10,000. 1/3 of 1,000 is 3,339. 13,000. Yeah, that's the answer. So whether you put 4 here or 3 here, it doesn't matter. Together, it should be 40,000 rupees. So loss will be shared between the bank and the customer. Bank will take bigger share of loss because bank contributed more capital. Customer will share smaller share of capital because customer contributed less capital. And that is how it will be shared. So for both of you all who gave me answers, very good. Although you didn't get it right, that is not the most important thing. Most important thing to try and see where our line of logic where we missed, and to get that correct. Because at the exam, we will if we don't get that right, we'll end up at the wrong answer. That happens whole lot of time. I've been doing this course for, I don't know, maybe 8-9 years, and I've seen that you start with the right note, but as you come in, if you don't practice, you end up with some wrong answer because we don't check. So people look at auditing my calculation. It's perfectly fine, but practice that will help you to clarify where you went wrong. Clear? Any questions on that? So what does this mean? What does this mean? This means the customer has to come to the bank and settle how much? Can you all tell me? What does this 26,600 loss for the bank means? For customer. Customer borrowed 400,000 There is a loss of 26,667. How much should the customer pay us back? Any answers? The customer pays us back 373,333. Yeah, that's the total amount he has to settle us. Why am I saying that? Is that clear? A loss means loss of business, a loss of capital. So if we had given capital of 400,000 and 26,000 is a loss, customer ends up paying only 373,000. So he comes to the bank, settles 373,000, whereas he borrowed from us 4 lakhs. He gives the 373,000 and says, "Thank you very much. I really like Islamic banking," and goes away. Because we have not assessed the possibility of losses on this particular transaction, right? We have gained losses. We have incurred losses, and that loss means loss of capital, meaning it will reduce our capital. So let's say, for whatever reason, customer didn't pay us back. If we sue him, if we do crystallize one of his securities, if we go for a parate action and sells his property, which he mortgaged to us on this facility, how much can we recover? We can recover 373,333. Of course, we can recover administrative cost of the process, but in terms of facility, what we can recover is not even the capital we gave. So although in Islamic banking you can take any security, when you crystallize those securities, when you have to recover from those securities, when you have to recover, you have to recover the amount due to you, and the amount due is calculated based on the underlying product that is involved. And here, if there is a loss, it will be foolish for him not to pay us, because he borrowed from us 400,000. He has to only settle 373,000 because there is actual loss, and that loss, net of that loss, he has to pay, and that is the amount due in this case. Is that clear? Any questions? So unlike just changing interest that is going to be charged as profit and charging something, here the actual transaction involves little more complexity. Because the underlying transaction is no longer a loan transaction. It is a profit and loss based transaction.
So
Yes.
If it is a loss, as you said now, 373,333.
Yes.
Okay,
Okay.
has to settle within 3 months.
Yes. This is after 3 months we are calculating.
After 3 months, yeah.
Yes.
Yeah. Then anyhow, customer is giving us lesser than what he borrowed.
Yes.
So why he comes and give that, if the even after 2 years or 3 years, if the customer the amount is same, that customer has to return.
Yes.
So why should he come within 3 months? So he has the option to wait till even after 2 years he has to settle the same amount.
Yes, that's right. So then,
In that case, is that mean that Islamic banking and Islamic banking, we don't consider the time value of money?
No, yeah. Let me clarify that question now. If what is due to us, he doesn't settle, we have to go for some kind of action to recover that amount, right? So that recovery, if he doesn't settle now and he drags on after whatever the policy, based on policy, after 3 months, whatever, let's say he has a property, we will take action based on that. But whether there is time value of money considered or not, is a question. So if it is a loan transaction, we don't consider time value. But if it is a business transaction, in this case, a Musharaka transaction, we are looking at expected return based on 3 months and calculate the profit, right? We did that, right? The tenor we took when we calculated that 18,000, right?
Yeah,
When we
18,000.
calculated for 400,000, the 400,000 into whatever expected rate into 3/12. Now this we are taking into consideration the
Tenor.
time value. Otherwise, this won't come. No.
Yeah.
This is expected time. So it is not precise like to the last digit. If he delays by 3 days, it will be instead of 3/12, it will be 3.1/12. Not precisely that, but there is a consideration. There is a consideration for the tenor of the facility that is brought into consideration when we are proposing the PSR, right? That's the first answer. So meaning time value is totally not considered in Islamic finance is not a correct statement. It is considered. It is not considered for loan transaction. Number one, loan transaction means not the facilities we are talking about. Loan transaction means it's similar to current account, I said. Meaning there is absolutely no repayment given. So Islamic banks don't do loan transaction. They do some kind of facilities, right? Mostly. Number two, it is not precise as in conventional banking. Now, conventional banking, if it delays by 323 days, it will be calculated for 323 days. In our case, it's not, right? Let's say instead of after 3 months, 90th day, he comes and pays us 93rd day. In this particular musharaka, meaning it's a transaction musharaka, we will not be able to charge him anything more, right? So in that sense, for that additional 3 days, it's not considered. But there are product structures where for the additional days also we can earn. For instance, instead of a transaction musharaka, if this was a organization level musharaka, meaning instead of investing in a particular tea transaction, if we invest in the tea company based on a gross profits for a month, instead of settling on the end of the month, the customer settles after 45 days, we can charge profits for 45 days. So even in musharaka, exact precise timing also can be structured. But this particular case, you're absolutely right. After the 90th day, whether he settles on 90th day or 93rd day, there is not going to be major difference between the actual amount of settlement. So there is this question. Of course, we will discuss under Murabaha, but since you raised it, I will explain this. There is this question, does it lead to a systemic risk? Meaning, if everybody thought like that, what will happen? So if everybody thought another 3 days, another 10 days, another 1 week, if I delay, the Islamic bank won't charge anything. What will happen? Everybody will try to delay the payments, delay the settlement. As such, it could it cause a systemic risk? So the answer to that is, if it is feared like that, if there is a delay and that could cause a systemic risk to the bank, banks are allowed by Sharia councils to charge what is called a penalty, where you can charge the same way like a penal interest you can charge. Only thing is you won't put in your profit, because it is treated as to discipline the customer. You are allowed to charge a penalty, right? Especially in product structures related to sale, we will discuss that when we discuss that under Murabaha. So there is allowance in Islamic banking to charge if every customer is trying to do that, and it creates a kind of a systemic risk for the system. you are allowed to charge. Even in Sri Lanka, certain types of products, some financial institution are charging penalty, so that customer doesn't make use of this leeway in an incorrect manner. Once in a way he delays, it's not going to be charged. But if it's a regular feature of many customers, bank is going to introduce a penalty and charge additional rate. Did I answer your question?
Yeah, on the time value of money, yeah, it's okay. Now, I mean, the loss part,
Yes.
whether the customer, even after 3 months, he has to
Yes.
pay 373,000 odd, and
Yes.
if we purposely delay, so he has the option to delay the transaction for about 2 years or 3 years. Is there any penalty for that thing? So otherwise,
Yeah,
the customer.
that's what I said. So in general, no. Now what is due is 373,000 only, whatever that amount we calculated. Now beyond that, he doesn't pay, recovery mechanism will kick in. So that will take its own course if he doesn't pay. But let's say he only for 15 days he doesn't pay, he comes back and says, okay, I'm settling everything. That is not additionally charged currently. That is the practice. But there are clauses in the agreement to charge this penalty, the additional amount I'm talking about, which is in the same way like a penal interest. There is a clause in the agreements, Islamic banks agreements, to charge the additional amount, so that customer is deterred from trying something like that. Even 373,000, he has to come and pay on time. Even if it is a loss, he has to pay on time. If he delays, now Islamic banks have brought in a clause of penalty so that there is no room for him to create or misuse the system. So that is there. But in practice, at least few banks I know of don't charge that, because customers in general come and settle on time. But there is legal agreement is there to somehow, if somebody purposely delays to charge, there is legal agreement and provision, and where in case by case basis, banks have charged also.
Okay, sir. Right. Thank you.
Okay. Right. Good. Where are we? Calculate the loss for the bank, calculate the profit or loss at PSR of 80/20 and describe exit mechanism if only 1,400 kilograms of tea is sold and 400. Okay, we have to do that. So here, the next question is, now this is also, I think somebody raised this question. So there is, now we have agreed for 3 months, right? And he was confident that he will be able to sell all 2,000 kilograms in 3 months. But after 3 months, when you go and see, he has sold 1,400 kilograms. 1,400 kilograms at 400 rupees. Right? So meaning 100 rupees, 100 rupees a kilogram in 1,400, 140,000 profit he has made. But he has another 600 kilograms not sold. Right? So actually, whether to use a profit or loss ratio is determined by the overall profit or loss, right? Not in this case, where only 1/3 or 2/3 is sold. 1,400 is only sold. So we can calculate the profit. So 80% for the customer. So 20% for the bank. 20% is 28,000. Is this right? This is the distribution. Is this right? This is the distribution of profits, 80% for the customer and 20% for the bank. So that can be calculated, right? But the exit mechanism is one is you can agree to value the stock at some basis and calculate the total profit. So you can agree the stocks are worth only at cost or only at the last sold price or some basis to calculate profit or loss, right? That is one. Or number two, market value. So first is market value. So based on the market value, you can calculate profit or loss, right? Number two, the customer can purchase from Musharaka, meaning customer becomes the person who we are selling it to at some agreed value based on the agreement. So in general, where you can't find sales, as long as this profit is acceptable to the bank, so 20% covers bank's expected returns, bank will sell him at cost, meaning there is no profit and total profit remains this. As long as bank has obtained its expected profit, which was 18,000 in our previous case, if that is to hold true, bank will still accept this and say, now the balance I'm selling at your at cost. So that is 300 rupees. So there is no profit here. But let's assume a case where where this value is only 290 now or 280, right? 280. Sorry. Which is below. So anything at profit or at cost won't be a problem for the bank as long as it has gained its returns, right? But anything at loss will reduce this profit and only the return, let's say it's 20 rupees a kilo. So 128,000 will only be distributed between 80-20 if there is a loss. So in general, in a short term, Musharaka, the exit mechanism is customer will buy back the stock at the cost price or whatever, can agree to buy back, or bank can determine the market, bank and customer can together determine the market value of the goods and then exit. The third option is to renew the Musharaka for some more period at whatever the rates applicable. So instead of 80-20, it may be 25 for the bank and 80 for the customer for the rest of the transaction, and go into Musharaka and see extend the Musharaka to facilitate customer to sell, right? So any of those exit mechanism is possible. The customer can accept the goods at a agreeable price mutually agreed between bank and the customer. If there is a market price, that market price can be used. Or if the bank's profits are covered, bank can agree it is at cost price and bring Musharaka to an end. The other is you can extend the Musharaka for another 3 months or 2 months at whatever profit sharing ratio agreeable between both the parties, and continue to wait for the customer to sell the balance also. So any of those options are possible. At least couple of options can be given for the answer. Okay, so we are almost out of time. We'll just quickly finish this last part. So what are the difference between a Musharaka and a conventional loan? by now you will be able to answer that, right? In terms of nature of contract, Musharaka is a partnership contract. Loan is just a standard loan contract. Returns based on PSR, on the profitability of the underlying transaction. Returns here is interest based on capital, based on the loan amount, capital of the loan, or based on loan amount. Losses are shared based on capital contribution. Here, no concept of loss, collateral. Any collateral can be accepted, but amount recovered is only the amount due. Amount recoverable is limited to only the amount due. Here, you can recover, any collateral can be accepted, and you can recover the capital, interest, penal interest, and any other charges, something like that. So based on the nature of what we have discussed so far, we can write few differences. So we can compare Musharaka and a conventional loan based on different features: the nature of underlying contract, how the returns are determined, the concept of loss, whether it's available and how it is done, whether it's not available, in terms of collateral, whether we can accept collateral, and if we accept the collateral, what is the amount we can charge. So those are some of the key differences which we can discuss when a question of how is it different from a conventional bank lending or conventional loan, we can discuss those. So with that, we can conclude. Any questions? So next week also we will continue these slides, hopefully. Any questions you all have so far?